At any moment in the waking world in these contemporary times, you will notice a section of human beings using a mobile, a laptop, engaging in buying something online, or seeing something using YouTube, scrolling through Insta. Now, how would it feel in case the benefits that these users get is being shared in a sense to you in terms of some kind of a remuneration? Hold that thought. Now picture all of this in your own farmland where you have multiple varieties of crops, a crop of Apple, a crop of Microsoft, Meta, Netflix, Google. And these crops yield regular dividends which can be reinvested into the farmland. And what would happen in case, say, there is a seasonal change and the contribution of one particular crop is inferior to the other, and hence you want to do some pruning, and the pruning happens automatically for you. There are other sections of crops also that you have, apart from the top 50% of your returns that these crops provide. The other crops, some of them may thrive and some of them may even fade away. But the ones that fade away and weed away gets automatically cleansed and gets replaced by something more superior. All this fancy story is good, but is there a practical way to accomplish this? Today, we will discuss a solution to create such a fairyland for us. Stay tuned. In both the National Stock Exchange as well as the New York Stock Exchange, that will help us accomplish these principles that we want to have in our investor farmland. The stocks which are diversified are available as a basket, and these baskets can get reshuffled. So let us say in the context of National Stock Exchange, you have the Nifty index, which has 50 trees, and the New York Stock Exchange, you have the S&P 500, otherwise, which has 500 trees. Now, let us take a simple example for a product so that we can discuss the product to wholeness and towards the end analyze and see which will be the ideal product for us. Say without the loss of generality, for the National Stock Exchange, let us talk about the Nifty ETF, the NiftyBees, and the US market with the S&P 500 as index. Let us talk about the SPY or the SPY ETF. Some trees may stop bearing fruit, others become diseased, new ones get planted. Every season, maybe quarterly or half yearly, you have the gardener, which is the index committee, who reviews the orchard and replaces the weak trees with healthier varieties. In National Stock Exchange, this season happens every half yearly. And in the New York Stock Exchange, for the SPY ETF, it happens every quarter. This is called as the index rebalancing principle. And hence, you are never stuck with a dead tree or a company. This is why, as an investor, you don't have to intervene. The orchard always has the best mix of fruit-bearing trees without you needing to worry. The next principle is that of arbitrage or the daily price alignment. Now again, come back to our farmland. Imagine there's a farmer's market next to your farmland where fruit baskets are sold. Sometimes buyers at the market pay a little too much premium, sometimes too little or a discount. Traders quickly notice and buy and sell the baskets versus the fruits directly from the orchard to profit. This constant activity keeps the market prices very close to true orchard value. That's the arbitrage mechanism. It ensures that you don't lose out because of temporary pricing noise. Now, why do arbitrage exist? ETFs like NiftyBees or SPY trade on an exchange just like a stock. At the same time, each ETF has an underlying basket of stocks which holds a net asset value. If the ETF price drifts away from the net asset value, arbitrators like the authorized participants will step in to profit, and in doing so, they bring prices back in line. Let us discuss briefly how the arbitrage works with an example for SPY. Suppose the ETF price is greater than the premium, that is the net asset value. Then what happens is the SPY trades at $501, but the value of the underlying 500 stocks, which is the net asset value, is actually $500. An arbitrager buys the underlying 500 stocks for $500, delivers them to the ETF sponsor, which is the one who is running the SPY ETF, and in return gets new SPY shares created. Then the arbitrager sells those ETF shares in the market for $501. The profit is equal to $1. But most importantly, this selling pressure pulls SPY price down towards the net asset value. On the corollary, if the ETF price is less than the net asset value or it is at a discounted price. So for instance, suppose SPY ETF trades at $499, but the underlying stock inside is worth $500, an arbitrager will do the reverse. Hence, the role of an arbitrager comes into play during every market up. The arbitrager makes profit, the ETF price is balanced, and hence the whole ecosystem gets benefited because the buyer of the ETF knows for sure that the value of the ETF basket is at par with the stocks that the underlying basket covers. How to select a good ETF for a diversified index-based fund? For accomplishing this, let us look at the top 5 criteria to pick a good ETF for an index fund. Number 1 is the expense ratio, which is the cost of ownership. Any cost, lower the better. So the passive broad market ETFs should be under 0.1% in general. There is a concept called tracking error. How well the real market follows the index. For instance, in the market of ETF, some funds lag their benchmark due to fees or poor management or execution issues. We have to look for funds with consistently low tracking error. Next criteria is the liquidity or the asset under management. Higher the asset under management, they are more stable with lower spreads and better arbitrage. Next, the underlying index, what we are actually buying, say Nifty 50 versus next Nifty, whether we are buying S&P 500 versus the Nasdaq 100, we have to choose a broad, diversified index with large liquid companies which represent their economy or the sector. Finally, the dividend policy, whether the aspect of reinvestment is there and to what extent it is taxed. ETFs that reinvest in dividends, which is the total return the index approaches, are better for compounding. Check the tax efficiency. For example, US ETFs are generally more tax efficient than the mutual funds. Now let us look at it from an Indian prism for us to find out which could be the right candidate for us to determine a good index ETF based on the 5 criteria that we just discussed about. The NiftyBees stands out, which is currently run by Nippon India. The expense ratio is approximately 0.05%, and it is at this point in time the lowest among the Indian ETFs. The asset under management is greater than 10,000 crores, one of the largest. The liquidity is very high, tracks Nifty 50 with minimal error. The dividends reinvested back into a name and it is not paid out separately. Now, for the US market, for the S&P 500, though in this example we had discussed the SPY ETF, the ideal candidate for us would be that of the Vanguard S&P 500 ETF or the VOO, because it has a least expense ratio of 0.03%. Asset under management, hold your breath, it is greater than $1 trillion. Liquidity extremely high. Tracking error is practically negligible. The dividends can be automatically reinvested. The alternative for VOO would be that of IVV, which belongs to iShares. It is also good. It also has a 0.03% expense ratio. There is another criteria that one can consider when we buy for the US market for S&P 500. It could be SPY ETF. This is extremely highly liquid. And the good part is for those of us who are into futures and options, the ability for us to get an option or a future in line with that of SPY becomes very easy. This is not the case for VOO and IVV. So these are the candidates that one needs to consider for the US market.
So in finality, if you want to own a corporate firm which has minimal overheads and can last for generations to come, then in the Indian market, it is the NiftyBees, and in the US markets, it can be the VOO or IVV. In tomorrow's section, we will look at how these indices respond towards inflation. Inflation is a waking reality that can rob away of the purchasing power of any investor. Stay tuned.